so here we are with chapter 3, and chapter 3 is really the beginning of the nitty-gritty of this class, because chapter 3 is all about tax planning and how we can use our knowledge of taxes and how they operate in the tax code, and some financial concepts as well, to maximize our after-tax wealth. Okay? So, let's get rolling. Whoops, and I just went back. All right, so kind of the basics. Where do we start from? All right, so in order to have effective planning, we have to take into consideration tax factors and non-tax factors. Okay? There's a whole avenue of academic literature that looks at taxes as not a factor, okay? But that is a very theoretical realm of academic literature, okay? Because we know in our practical daily lives that taxes are a factor. They are an actual cash cost for us and for other taxable entities like C corporations, right? So taxes matter, okay? So in general terms, effective tax planning maximizes, all right, the taxpayer's after-tax wealth, all right, while achieving non-tax goals. Notice it does not say that the strategy of effective tax planning minimizes taxes. That is not the goal. The goal is to maximize after-tax wealth. And you might be wondering, okay, well, what the heck is the difference between minimizing taxes and maximizing after-tax wealth? Well, the difference is maximizing after-tax wealth also takes into consideration non-tax goals. All right? I can minimize my tax liability. Right? The easiest way to minimize my tax liability is, well, make less money, right? I can quit working and have less taxable income, okay? And then I pay less taxes. So I have now minimized my tax liability, but I have not then maximized my after-tax wealth, okay? So that is obviously a very extreme example, but what we have to look at are ways by which we can maintain, right, a standard of living and maximize our after-tax wealth. Okay, so that is the goal of chapter 3, is to kind of get a handle around the constructs and how we could actually do some of these things. Okay, now there are 3 parties to every transaction. All right, and so who are those 3 parties? Okay, well, as we're trying to decide who those 3 parties are, who is doing the taxing, right? Well, that would be the government, all right? So the government is one party, all right? Who is another party, all right? Well, that'd be the taxpayer, all right? But who is that third party? Well, so the third party, and you're going to kind of laugh at this, I'm going to write down as the other party, which, you know, if you just look at that term, it makes no sense. But what I mean by that is, okay, so you have the government, and then if I am a taxpayer and I am buying something, who am I buying from? Well, I'm buying from the seller. So if there's a buyer, there also has to be a seller, okay? So if the buyer is the taxpayer, then the seller is the other party. Similarly, if I'm selling something, right? If the seller is the taxpayer, then the buyer is the other party. Okay? So 3 parties to every transaction. All right? Now, along with that, there are 3 basic planning strategies. And we're just going to write them down here, and then we'll define them and kind of categorize things later on. All right? So we've got these 3 basic tax planning strategies. All right? The previous slide, there we go. And our 3 basic tax planning strategies are timing, all right? Income shifting, all right? And conversion. And we will define these here as we go along. All right, so let's talk about timing first, okay? So what are we talking about when we talk about timing? Well, we're talking about when income is taxed, right? So when matters, okay? So we are cash basis taxpayers. So what that means is in the year that you receive the income, for the most part, is the year in which you get taxed on the income. So the time that the income is taxed or an expense is deducted is the present value, right? Affects the present value of the taxes paid, okay? Or the tax savings, right? So as tax rates change, those tax costs also change, all right? So what are we doing when we're talking about a timing strategy? Well, we're harnessing the present value concept, right? We know that $1 today is worth more than $1 in the future. Now, how much more is based on a couple of factors, right? How much more is based on, well, how far in the future are we talking about? Are we talking about tomorrow? Are we talking about next year? Are we talking about 5 years from now, right? If I look at you and say, I'll give you $5 today or $5 tomorrow. Well, you'd rather have the $5 today, but wait until tomorrow, no big whoop. If I say I'm going to give you $5 today or $5 3 weeks from now, well, now you'd much rather have that $5 now. But if I said, okay, I'll give you $5 today versus $10 in 3 weeks, you might be willing to wait the 3 weeks. So time matters. How much in the future are we talking about? Okay? If we're talking about cash inflows, all right, so cash coming to us, all right, what do we know? We know that we would rather have higher present value. If we're talking about cash outflows, what we have to pay, we would want lower present values. Okay? So we're going to go back to the previous slide and we're going to look at this, we're not going to move it around. We're going to look at this formula, all right? Present value equals future value, right? Divided by 1 plus r to the nth power. And we're going to rewrite that. All right? Let's do a fairly straightforward example. All right, so here we go with our example. So we've got this holiday sale, all right? And Bill and Mercedes are going to purchase $1,000 worth of furniture with no money down and no payments for 1 year, right? Fairly standard scenario. How much is this deal really worth? All right, so we're going to assume their after-tax rate of return on investments is 10%, okay? So that is fairly important, all right? So right now we're going to pause. All right, and we're going to go back and look at a formula, okay? And then we're going to answer this question with that formula, all right, in our example. All right, so here we go. Now, in this situation, what are we trying to find? Okay, what we're trying to find is how much is this deal worth? Okay, so we have to understand what our terms are. Okay, and so our terms, what are we wanting to do? Well, we're wanting to find our present value. So this is what we want to find. Okay, what we know, well, we know our future value because we know at the end of a year, right, we're going to have to pay $1,000, right, because we're buying furniture worth $1,000. Okay, now the question is, what is this? Okay, and how do we find present value if we know our future value? Well, if you have a financial calculator, right, then you can plug that in, and what do we know? We know that R is our, in this case, after-tax rate of return, and N is our time, okay? So if you're plugging it into your financial calculator, you do it that way. Now, obviously, you can use your financial calculator, but I am not going to be able to assist you because everyone has a different financial calculator, and who knows, I don't anyway, how to operate all of the different varieties of financial calculators out there. So all right, so if we go back, now, all we have to do when we're using those factors is multiply that by our future value to get our present value. And so what is our present value? Well, our present value is $909. Okay, so how much are they saving? They're saving $91. Okay, their saving amount, hold on, let me scroll up here. Saving equals future value minus present value. All right, so 91 equals 1,000 minus 909. All right, we use consistently is these present value tables. This table will be available to you on all tests. I've got it posted on our Canvas site, okay? And this is how you use one of these tables if you haven't used them before. This is your R, okay? So in our situation, we know that our after-tax rate of return is 10%, okay? So that's our little R. And then our N is the time. That's that column, right? So we know that we're talking about 1 year. So this is our factor, 0.909. Now, how the heck do we use that thing? You're about to find out. This table, we will use this table in lots of instances in this chapter, and going forward, you will find this table helpful as well. Whoops, there we go. All right. And what was our after-tax rate of return? Well, our after-tax rate of return was 8%, and it was 1 year again. So 0.926 is our factor. Okay? All right, so timing strategies. 2 basic timing strategies. All right? Accelerating deductions. What does that mean? So if we're accelerating a deduction, all right, what are we doing? Well, if we're accelerating a deduction, that means we are going to recognize tax deductions sooner, and deferring income, we're going to recognize taxable income later. All right. So if we had our preferences, right, all else being equal, we would like to not recognize taxable income this year or not be taxed on that income this year. Okay. And we would like to be able to have more deductions currently. Okay. One more. So let's do another example. All right, so now let's look at a directly related to tax example, okay? So we've got Mercedes again, and she's a calendar year taxpayer, and she uses the cash basis method of accounting for her small business. On December 28th, she receives a $10,000 bill from her accountant for consulting services relating to her small business. So what that means is her accountant is charging her, and she's going to get to deduct this, okay? She can avoid late payment charges by paying the $10,000 before January 10th, all right? So she could pay it this year or next year, right? Because the end of a tax year is December 31st. Assume that her marginal tax rate is 30% this year and next, and that she can earn an after-tax rate of return of 10%, okay? When should she pay this bill? So should she pay it before the end of the tax year, or should she pay it January 2nd, right, which is the next tax year, but she doesn't have a late fee? All right, so what do we need to remember? Well, we need to remember that this after-tax rate of return is her little r, okay? N in this situation is 1, right, because we're talking this year or next year, okay? And now we're going to use this present value strategy, okay? So remember, present value equals future value, right? Times a factor, all right? And so what is that factor? Well, our after-tax rate of return is 10%, and we're still talking about an n equals 1, so our factor is still 0.909, all right? So that's kind of cool, okay? So, all right, so what I like to do for these situations is figure out what would happen this year and then what happens next year, okay? So if we pay this year, all right, what is our tax savings? Okay, well, this year's tax savings is our $10,000 times our marginal tax rate, which is 30%, which equals $3,000. So that's our tax savings if we pay this year. Okay? Now, let's look at next year. Okay? All right. So next year, tax savings. Oops. Well, what do we have to do? Well, before we can figure out our next year's tax savings, we have to figure out what our present value is, right? Because if we're paying the $10,000 next year, then our future value is $10,000, okay? So what is our present value, right, of that $10,000 if we pay that next year? So our present value then, and I'm going to slide this way a little bit, make myself some space. 9090. Okay? So what is our tax savings? Well, we have to use our present value times our marginal tax rate, which we know is still 30%. And so what does that equal to? Well, let's figure that out. All right, so now we've got tax savings for next year, right? Versus, whoops, I'm going to scroll back down. Here we go. Tax savings for this year. All right, if we're talking about tax savings, would we rather have larger tax savings or lower tax savings? All right, I would rather have larger tax savings. Okay, so since we would rather have larger tax savings, what would we choose? Well, we would choose to pay the bill this year. Okay, choose to pay this year, since the present value of tax savings is larger. Okay? Let's go for. All right, so in our last example, our tax rate stayed the same. So that's kind of, you know, the easiest planning situation, because you don't have to worry about tax rates changing, and you've got some standard variables to deal with. Well, what about when rates are increasing? Okay, so now if the tax rates are increasing, you got to calculate whether the benefit of recognizing the deduction now outweighs what could be happening if you deducted when tax rates were higher, okay? Or what about if tax rates got lower, okay? So now you have to figure out what your cost-benefit analysis looks like in a situation, okay? So you're going to calculate whether the benefit of accelerating deductions outweighs the disadvantage of recognizing deductions in a lower tax rate year, right? Say, for example, my tax rate this year is 20%, but I know my tax rate next year is going to be 30%. Do I still want to deduct that payment this year rather than next year? Well, the answer is much less certain. The answer is it depends, okay? So now you have a couple more calculations to do in order to know that. All right? Same kind of situation if tax rates are decreasing, right? Normally, we've said we want to recognize income later. We want to defer income, all right? But if we know tax rates are increasing, we would want to recognize income now, potentially. If we know tax rates are decreasing, all right, deferring income is a slam dunk, but now deductions, maybe we don't want to defer them. All right, so let's look at some examples with numbers. And here's the slide. Hopefully, we can clarify some of these conceptual situations. All right, so now we've got Mercedes again, and she's decided she needs new equipment for her business, and so she's considering whether to make a purchase and take a corresponding $10,000 deduction this year or next year, okay? She anticipates that with the new machinery, her business income will rise, all right? And her marginal tax rate is going to go from 20% to 28%, okay? If her after-tax rate of return is 8%, what should she do? Okay, so the question is, do we deduct this year or next year? All right, so what we have to do is we have to calculate our tax savings for both those time periods. So let's look at this year. All right, so it's $10,000. And what's our marginal tax rate this year? All right, so our marginal tax rate this year is 20%. So our tax savings this year is $2,000. Okay? Now, what's our tax savings next year? All right? So, what's our tax savings next year? Okay? Well, we've got that same $10,000 payment, but we know our tax rate next year is 28%. So that is $2,800. But remember, we are going to have to discount that back one year, right? To be able to compare things. Okay, so what do we have to do? Well, we're going to have to find those factors again. Okay, so I'm going to scroll back a couple. Okay. All right, so our factor is 0.926 times 2,800, which equals 2592.8. All right. So what are our tax savings? Well, our tax savings this year, if we paid the bill, is $2,000. Next year, because our tax rate has increased so much, our tax savings, even with the present value calculation, is over $500 more. So what would we choose to do? Well, we should deduct, so buy the equipment next year. Okay? All right, so as you might expect, there are some limitations to timing strategies. All right? We are tax basis taxpayers, or cash basis taxpayers. What that means is you cannot, in most cases, make a deduction without actually paying the bill. Okay? Typically, in order to defer income, you have to continue your investment. So what does that mean? What that means is in order to not be taxed on the appreciated value of a stock, right? You have to hold on to that stock. As soon as you sell that stock, you're taxed on the capital gain. All right? So there are some limits to timing strategies. All right? Also, if you need cash flow, deferring the earning and receiving of income may not be ideal, right? So we also have this concept of constructive receipt, all right? And what constructive receipt says is that if you have the ability to control, right, when this income is received, or when you actually have the ability to recognize, to use, I should say, this income, then you have to recognize that income for tax purposes. All right? And the example that I like to use is it used to be that there was a good deal of float when you wrote a check or made a payment, because payments had to go through the mail, and so I could write a check and then drop that check in the mail, and then it would take a couple of days to get to wherever I was paying that bill, and it would take them a couple of days to get it cashed and have the transaction to go, and sometimes you would have 8 days of float. Okay? So consider a situation where your employer wants to give you a bonus at the end of the year. But that bonus is going to throw you into the next tax bracket. And so you would really like to not have that bonus this year. You would like to have that bonus next year. Okay? So they tell you, hey, you're getting a bonus. It's December 26th. You're thrilled. They're putting that bonus check in the mail. All right? And so now you know that that bonus check is going to be sitting in your mailbox as of December 29th. All right? Constructive receipts says that if that bonus check is sitting in your mailbox, whether you walk down and get it out of your mailbox or not, you have to recognize the income related to that bonus check this year. You can't decide, I'm not getting out of my house, I'm just staying here in my jammies, I'm not going and checking my mail, and then walk down to your mailbox on January 1st, collect your check, and have that be taxable income for the next year. Constructive receipt says you had the ability to go down to your mailbox and get that check. So therefore, you have to recognize that as taxable income in the current year. Okay? Let's talk about income shifting, all right? Because income shifting exploits the differences in tax rates across taxpayers. Okay, so transactions between family members, right? So it would be great. My children have a lower marginal tax rate than I have, right? Because, well, they're 10, 13, and 15. And as I always tell them, they're chronically unemployed because they're 10, 13, and 15. So they don't have the same income that I have. So their marginal tax rates are much less. So if I could have UMSL split my salary and have large portions of my salary go to my 3 children and be taxed to them instead of being taxed to me, that would be advantageous from a tax strategy, right? Okay, now it turns out you can't do that because of assignment of income, and we'll talk about that. But if I could move income to family members with lower marginal tax rates, that would be advantageous. We'll talk about ways by which you can do that. There are different tax rates between owners of businesses and that business entity, right? So you can use those types of transactions in order to lower your overall tax liability. There are also differences in jurisdictions, okay? Illinois has different tax rates than Missouri, right? So we can use those differences in taxation across jurisdictions to help us from a shifting perspective as well. All right? Now, assignment of income is a judicial doctrine that limits our ability to shift. All right? What the assignment of income doctrine says is that you cannot separate the tax liability, right? You can't separate the income from who earned it. All right? So my idea to split my UMSL salary between myself and my 3 kids and save taxes is faulty because of assignment of income. Assignment of income says I earned that income, therefore I earned the tax liability related to that income. Okay? The Supreme Court is who promulgated this assignment of income doctrine in a tax case, and what they said was you can't separate the fruit from the tree that bore it. Okay? So that's income shifting. All right? We also have conversion strategies. All right? So conversion strategies deal with changing one type of income for another. All right? So what do we know? We know that different activities have different tax rates. Okay? Ordinary income is taxed at ordinary rates. But what about long-term capital gains, right? They have preferential rates. And there's income that's totally tax exempt, right? We discovered that municipal bonds are tax exempt, okay? So how does that benefit us? Well, if we can take our income and put it into some type of a vehicle that is taxed differently, then that's a conversion strategy, right? We're trading or changing ordinary income into preferentially taxed income. So say I earn a salary, all right? That's ordinary income, taxed at ordinary rates. Now, what if, though, I have the option of investing a corporate bond, a municipal bond, or a stock? All right? 3 very common investment vehicles. But what's the difference? Okay, if I invest in a corporate bond, I get interest. And that's taxed at ordinary rates. What do we know about a municipal bond? Well, I get interest, but that interest is tax exempt. All right? What about my stock? Well, my stock appreciates, right? If I hold it for more than a year, then it gets taxed as a long-term capital gain. All right? If I get a dividend, that is taxed at preferential rates, right? So this is how you convert ordinary income into potentially, in these situations, a preferentially taxed type of income. Okay, so let's do an example. All right, so here we go with our conversion example, and this directly relates to some homework and some topics that the book talks about as well. All right, so we've got Bill, and he's contemplating 3 different investments, each with the same amount of risk. All right, so take risk out of it. You got a high dividend stock that pays 8.5% annually with no appreciation potential, so we don't have to worry about that other variable. You've got a taxable corporate bond that pays 9% annually, okay? And you have a tax-exempt municipal bond that pays 6% interest. Assume that dividends are taxed at 20%, all right? And that Bill's marginal tax rate on ordinary income is 30%. The question is, which investment should Bill choose? Okay? So, the first thing we need to realize is that whenever we're given our rates of return, okay, these are pre-tax rates of return. All right, so hold on, I'm going to move things around here a little bit. So, we are always given pre-tax rates of return. Okay, now that's fine and dandy, except what do we know from a tax planning perspective? We need to compare the after-tax return, right? Because we don't live in a theoretical world and taxes are an actual cost. So we have to plan for them and we have to pay them. So we need to calculate for them, right? So what we need to do is to compare the after-tax rates of return and choose the highest. Okay? All right, so in order to compare the after-tax rates of return, we have to calculate the after-tax rates of return, right? All right, and you may be asking yourself, well, that's great. How do we do that? Well, this is how we do that. So we talked already about the best tax formula ever, right? And the best tax formula ever was after tax equals pre-tax times 1 minus the tax rate. All right? This is the greatest tax formula ever because this is what we're going to use for this type of situation as well. All right, so let me move things around again. Okay? And so we're just going to go through our three options. All right? So let's do the high dividend stock first because it's listed first. Okay? So the high dividend stock. Okay? After tax is what we're looking to find, right? We're told its pre-tax is 8.5%, which is 0.085, right? We're told that the tax rate on dividends is 20%, right? So after tax equals 6.8%. All right, great. Doesn't tell us, it tells us what the after tax rate is, but it doesn't answer our question yet. Okay, so now let's look at the corporate bond. Okay, again, after tax is what we're looking for, and we were told that this taxable corporate bond pays 9% annually, which is a fantastic rate of return, but we also know that our ordinary tax rate is 30%. Okay? So what does that give us? That means that our after-tax rate of return is only 6.3%. Well, that's unfortunate, right? Because it had the highest pre-tax rate of return, but it does not have the highest after-tax rate of return. All right, but we have one more to deal with. All right, so let's talk about the muni, the municipal bond. All right. All right, so what are we given? Well, we're given its pre-tax tax rate, right? Which is 0.06, all right? What is its, I'm sorry, I said pre-tax tax rate. Its pre-tax rate of return was 6%, that's right there, okay? And then what is the tax rate on a municipal bond? Well, it's 0%, right? So what is its after-tax tax rate? Well, I said it again. Its after-tax rate of return. Its after-tax rate of return is the same as its pre-tax rate of return because it's not taxed. And so that is 6% for an after-tax rate of return. Okay? So based on that, what should Bill invest in? Well, Bill should invest in this high dividend stock because his after-tax rate of return is higher than his other two options. Okay? That is how you deal with a comparison of investment scenario. All right, so as you might imagine, there were limitations with timing strategies, there were limitations with shifting strategies, there are also limitations with conversion strategies. Okay? So, what does that have to do with? Well, you can't just create transactions that are kind of nonsensical, all right? There is this substance over form. So if it looks like a lease, but you say it's a sale, guess what? It's going to get treated as a lease, okay? Your transactions must have a business purpose beyond tax avoidance, okay? So these are some good examples of judicial doctrines that are designed to limit our ability to kind of skew our tax liability by conversion strategies. Okay. All right, so the code itself. All right, so here we are for the final slide of Chapter 3 lecture, tax avoidance versus tax evasion. All right, now, both of these terms may sound like something awful, but it's important to realize that tax avoidance is completely legal and something we should do, and we all do, and that is legally minimizing your tax liability. All right, tax evasion, on the other hand, is illegal. I'll write that down here. Illegal. All right, it is the willful attempt to defraud the government. Now, tax avoidance, sometimes when they talk about corporations avoiding taxes, they make it sound like something other than what it is, all right? If the term being used is tax avoidance, that means it is legal, all right? Now, sometimes it may be aggressive tax avoidance, and there may be some issues with the methodology, right? But if it is tax avoidance, then by definition, it is legal, all right? We all participate in tax avoidance. Anytime we have a deduction, right, that's tax avoidance. I avoid gas taxes on a regular basis because Missouri has lower gas taxes than Illinois, and I live in Illinois. But when I drive in Missouri, I make sure to fill up my gas tank because I am avoiding gas taxes, all right? I deduct home mortgage interest. I deduct expenses related to my children's education that are allowable. I deduct charitable contributions. These are all examples of tax avoidance and are completely legal. All right? So that is it for Chapter 3 and tax planning from a lecture perspective. We will do tons and tons of example problems, and there are practice problems posted. So have fun, and I will talk to you later. Bye.